Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week we'll have a look at the latest global inflation data. We'll also have a look at inflation data coming out of the US. We'll look at some indicators coming out of China. And finally, we'll have a look at the South African commodity export basket. We're going to start off with global inflation. So far, we've had 40 inflation prints for the 50 largest economies across the globe. And median inflation has ticked up to 2.7%, up on where it was last month and up on where it was the month before. There's now broad-based evidence of global inflation heading in the wrong direction. And in addition, inflation surprised on the upside for 50% of the countries that are reported, and that's very similar to last month. So not only has inflation ticked up pretty much across the globe, but it's also surprised on the upside. Looking at the US in particular, US inflation came out at 2.7%. That's in line with the June reading. And actually in the US, it was slightly below the consensus expectation. Consensus was expecting 2.8, came out 2.7. The market really liked that. It opened up about 30 basis points, and the market in the US on that day closed about 1% higher. So clearly, the market is very sensitive to marginal shifts in inflation and shifts in inflation relative to expectations. And this is a series that we're going to have to keep a very close eye on over the coming few months. If we dig a little into the data, month-on-month inflation in the US was 0.2%. If it stays at that sort of rate, and that's an optimistic assumption, I think, given tariff increases, nonetheless, let's for the moment assume that month-on-month inflation remains at 0.2%. Under that environment, US inflation is going to remain at about 2.7% for the foreseeable future. It's very unlikely that US inflation is going to be getting to 2% by October or any time before that. You would need inflation, month-on-month inflation, to be running at about 0%. And that seems very unlikely at this point. So I think we can pencil in US inflation remaining above 2.5% for the foreseeable future. But in addition to that, there were some other reasons for concern in that inflation print. For instance, if you look at core inflation, that was above 3% and surprised meaningfully on the upside. And there's a worrying trend developing where core inflation is up on where it was over the past couple of months as well. And the reason that's concerning is the central bank does concern itself with core estimates of inflation rather than headline estimates of inflation. And the core inflation story isn't anywhere near as good as the headline estimates. But in addition to that, there's two key leading indicators for inflation in the US. The ISM Services Prices Paid series, we spoke a bit about that last week. That series is suggesting that US inflation is going to be north of 4% within the next couple of months. And if you look at PPI inflation in the US, that number came out last week. It surprised materially on the upside. That number is sitting well above 3%, also suggesting some upside to inflation ahead in the US. And in addition to that, if you look at super core inflation, so core services inflation, ex-housing, that series has been increasing as well, sitting at about 3.2%. So all told, what we can read from the inflation data is that there are certain key signs that US inflation is going to remain elevated for the foreseeable future, and there's probably some upside to inflation in the US over the coming few months. Nonetheless, the market took the reading very well, and as mentioned, the US market was up about 1% of the day, and the fixed income market is now pricing in about an 80% chance of a cut in September. And that is difficult to reconcile with the inflation data unless one simultaneously thinks that growth is going to slow. And I think that's probably the best way to get an understanding what the market is pricing at the moment. It's pricing in inflation to remain elevated for the foreseeable future, but at the same time for growth to slow based on the non-farm payrolls data, and that allows the Fed sufficient space to be able to cut. But if that is the right way to read the market at the moment, it still does nonetheless raise the disconnect. If growth is going to slow, why is the US equity market on a forward PE of 22 times? And why are credit spreads in the US sitting at 25-year lows? So there is still a disconnect that's difficult to explain. We've got an equity market and credit markets that are very optimistically priced, suggesting that there's no growth slowdown at all. And in fact, if one looks at the latest Atlanta Fed GDP now estimate, it's running at about 2.5%. So that all reconciles on that side. But at the same time, we've got inflation, which is proving to be pretty hot, and the market pricing in 4 rate cuts over the coming 12 months. And it's difficult to see how that happens without a growth slowdown. So there is a disconnect between the equity market and the credit market, pointing to strong growth, and the short end of the fixed income market in the US, which is pointing to growth weakening, allowing space for the Fed to cut. Now, there still is one non-farm payrolls print before the next Fed meeting, and there's a CPI print. I suspect those numbers are going to be very important in attempting to reconcile that disconnect. And just on that Atlanta Fed number I mentioned before, while the Atlanta Fed estimate is sitting at 2.5%, the consensus forecast at the moment is sitting at just 1%. So there's a big disconnect between the two. And again, we're going to see how this is reconciled over the coming few months. Switching to China, Chinese inflation is very low, sitting at 0%, well below the central bank target of 2%. And there is still ample scope for stimulus in China. The question is whether there's need. Exports for China are up 7% year on year. That's much stronger than one would have expected. Come the Liberation Day announcements back in April. And as a result of that, it might be the case that the Chinese authorities feel they don't need to stimulate quite yet at this point. And also, if one looks at other leading indicators for the Chinese economy, like total social finance, they're all pretty strong as well. And that's resulted in pretty strong metal prices. If, for example, we look at copper's up 7% over the past 12 months. It's up around 2% over the past 3 months. And Dr. Copper is not suggesting there's any weakness in the Chinese economy at all at this point. And iron ore is up 14% over the past year. This mix of commodity price strength is clearly very helpful for commodity exporting emerging markets, and does more broadly suggest that global growth at this point is probably okay and aided by lower energy prices too. For South Africa, we've created our own basket of South African commodities. It's weighted by how important each commodity is for our export basket. And that basket has done very well in dollar terms of late. If we look at the 6-month average, that 6-month average is now up nearly 10% year on year. It doesn't often happen. It's happened on a few occasions over the past 15 years. It is the typical cycle for South Africa. What happens is we see very strong commodity prices that leads to improved export revenue and better revenue for the state, and that allows for a stronger rand and, in addition, some form of fiscal support, and that in turn leads to stronger SA Inc. So we're at the start of this part of the cycle. At this stage, retail sales growth is still pretty tepid, but should it pan out in the usual way, we would expect that this sort of commodity price strength will translate into an improved SA domestic economy within the next 6 months or so. So this is critical. We've got to keep an eye on these commodities. But as things stand at the moment, this should provide a quite strong tailwind for the SA economy over the coming few months or so. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.